So, good afternoon, everybody. For those who don't know me, my name is Sonny Barkatz. I'm the founding partner of JS Barkatz, a boutique corporate securities law firm in Manhattan. We specialize in all sorts of corporate securities deals. We do reverse mergers, pipes, but for the past year and a half we have been actively working around a provision, an exemption under the 33 Act, namely Regulation A offerings. So let me ask a question to everybody who's left in the room before they left for the break. How many of the bankers in the room have done a Reg A offering in their career? Would you mind raising one? I heard that you did a few actually. 2, 3, okay. Definitely not the majority. And believe it or not, Reg A has been with us for a long period of time. It's a provision of the 33 Act. And basically, Reg A allows private company, non-reporting company, to raise capital up to $5 million. The shares are going to be declared qualified / effective by the SEC. Free tradable. Solicitation has long been allowed even before the Jobs Act. And the amazing thing is you do not need audited financials, and there is no limitation as to the amount of non-accredited investors that could participate in the deal. Small parenthesis, it was supposed to be a panel discussion. Nobody came, so I'm going to be playing a little bit devil's advocate. So I know one of the panel members would be thinking that it's outrageous that you do not need audited financials and that so many non-accredited investors can participate in the deal. So I'll argue that, you know, Reg A is the democratization of capitalism and the ability to solicit anybody and have them participate. There is no limitation, contrary to the Jobs Act, Title III, on the amount of money a non-accredited investor can put into a prospective transaction. However, Reg A requires blue sky filing. It's a state-per-state procedure, and aside from 17 states that are merit state, most of the state, it's pretty technical and it's a blue sky procedure. But in the merit state, including California among them, the procedure could be quite grueling and take some time. So the way it works is the following way. We have done, okay, Reg A in the past few years, you can count on your finger how many have been filed. In 2013, there is 24 pending offering statements. It's called a Form 1A. So I don't know whether I have on the PowerPoint because they sent me the wrong one, but I work with it. That's the new provision of the Jobs Act, which will either amend Reg A to 50 million, but then require audited financials. And yeah, disappeared. So you have on the table a sheet which compares all the different type of offerings that allow solicitation. If you have it on the table, I recommend you take it, keep it. It's a good summary. Matt Carroll, one of our top associates here, prepared that, and it's fairly accurate. It summarized the different type of offerings that allow you to raise capital at large. There is not many. Not many people would praise today Title III and crowdfunding, which is limited as per the Jobs Act and the implementation that is going to happen in the next 35 days remaining on the comments of the crowdfunding procedure. Crowdfunding, as you by now all know, allows you to raise only $1 million per 12-month period. You do not need audited financials. However, if you raise more than $500,000, then you are required to provide audited financials. Not a lot of companies can benefit from a $1 million raise to be sustainable. Yes, if it's a neighborhood type of restaurant or a small mom and pop business that raise money through crowdfunding, which mandates that they solicit it only through the portal or their BD, which limits the scope of the possibility of raising that money, not many people will tell you that crowdfunding is a viable way today, unfortunately. There was a moment where all of us felt that the legislator understood that capital formation had to come from the bottom up, and therefore the Jobs Act was implemented. But when you look at the rules under Title III, most of the lawyers here in the room will tell you it's not really a viable option for most real companies. Therefore, if you look, and I know somebody here is a broker or a banker for Reggae, I'd like to catch up with you eventually. If you look at the rules and procedure under Regulation A, the fact that you can solicit anybody through any medium, it is the perfect vehicle at the crossroad of social media and capital raise. So you have a product that is attractive to your followers. Your followers can become your shareholders and therefore your best evangelists. Any consumer good product, any concept can be followed by the non-accredited investors and allow them to participate. So there was a lot of argumentation about fraud with regard to the Jobs Act, and people are always saying, you know, crowdfunding, it's dangerous, it's predominantly going to be a platform where people can solicit and build scam and raise money. But the data doesn't suggest that fraud is going to happen on the crowdfunding provisions. In England, it has been operational for equity for the past 4 years already. There is one of the dominant side equity sales to non-accredited investors called Crowdcube. I don't know if you have heard of that site. And Crowdcube has done about 75,000 offerings. Zero fraud has been detected. Kickstarter is a site that everybody knows about, which is donation-based crowdsourcing. And out of more than 145,000 capital raise offering, only 4 cases of fraud have been detected, and by the crowd, by the way, not by the SEC, not by the regulator or anything like that. So the argument of fraud in a crowd-like forum is not the most powerful argument based on the historical data. We, at our firm, I've been filing, I would say, out of the 24 filed this year, we filed 8 Reggae offerings, and got 2 completed in 2013 successfully in a very short period of time. The followers of our clients, which are private companies, were able, the consumer, the end buyer, were able to become also shareholders, equity owners, with no limitation on the amount of capital they could participate in. Obviously, some could argue that how do you protect the non-accredited investor? Why is the SEC allowing that? And quite frankly, I don't know. And I would disagree with relying 100% on the regulators to protect them from their ability to participate in an investment, as speculative as it is. We're working on a new product at our law firm, which is called the DAPO, which is a Direct A Public Offering. And many companies know what a reverse merger is. Many people have flirted with pipes and have flirted with going public through a self-registration, filing a Form 10 or doing an S1. However, we believe that if you do that, you should build your shareholder base before you go public. So Reg A would allow you, first of all, to raise capital, solicit non-accredited investors up to $5 million with no audited financial, or you could have audited financials, which I believe would be better and safer. And then take that core shareholder base, even if it's 2,000, 3,000, 4,000 shareholders for a little amount of money, and do a self-direct public offering, therefore building volume, therefore building capital, liquidity eventually, and now you can sign a deal with any technical investors, whether it's a pipe fund or a convertible debt structure. But before you have a big chunk of shareholders with you, and I'm talking in the hundreds, going directly into the public market with a Form 10 or an S1, you're probably not going to make it. Most of the investors in the small cap market are looking for liquidity and volume, and that's the criteria for their investment. The good news is with Reg A, by doing so, all those shares will be free tradable even before you get a symbol. And therefore, you could benefit from that possibility of having a real market. The good news also is you are raising money from non-smart investors, which means their considerations are different from the VCs or the pipe funds or any complex accredited investors who wants to make the best deal. Today, with the social media, we are witnessing firsthand a sort of revolution in the way people raise capital or create attention on their product or company. There was an example that maybe many of you know about called the Pebble Watch. Pebble Watch was an idea that everybody knows about today because Samsung took it and did it. The Pebble Watch was basically a bunch of kids that came up with inventing a smartwatch. They didn't produce yet the watch, they had only the intention and the idea of doing so, and they went on Kickstarter, a crowd-sourcing donation-based site, where people could give money in exchange for a widget, and their goal was to raise $100,000. But because their video went viral on YouTube, within 37 days, not giving a piece of equity at all, they raised $10-point-something million. Turn around and build a watch. So my point is, there are vehicles in our laws that allow all of us to benefit from solicitation and allow the participation to non-accredited investors without limitation but for the $5 million cap. Many companies here, $5 million would be plenty of initial seed money, and you have to be prepared because Section 3B2 of the Jobs Act, which is also known as Reg A Plus, will increase that threshold to 50 million. There is a debate whether it's an amendment to the existing provision of Reg A or whether it's a new rule called Reg A Plus that would be allowing for the same, but at 50 million. Again, the biggest hurdle for Reg A is the blue sky filings. And if you can deal with blue sky, and there is some companies that do that, law firms do that, it's a state-by-state issue, you could easily file your prospectus, which is called an offering statement under Form 1A, with the SEC, and from the moment you file that prospectus, you can immediately get the money into escrow, third-party escrow, not close on that money with a provision that says that you will return the proceeds in the event that the registration statement or the offering statement hasn't been declared qualified/effective. So we are a big proponent of that type of offering. We believe that the investment banking industry should quarterback those type of transactions. I'm very pleased to hear for the first time that there was here an investment bank that does exactly that, and I think that's a pioneer in something that needs to be done more often and sold to our issuers, so when they go public, they have a stronger basis for sustaining what's to come. When you do a reverse merger, for instance, you all know we have the seasoning rules in place, which mandates that the company has to be public for a certain period of time before it can uplist. If you don't have capital, if you don't have shareholders, that seasoning period can turn to be pretty deadly for those companies, locked and precluded from accessing capital from institutional or qualified investors. Therefore, lacking of a panel to argue with me, I'm right, and therefore, you know, I think that a viable alternative to crowdfunding Title III, a viable alternative to PPM on the Reg D, and I will touch a few points on that, especially with 506C, which allows solicitation. Reg A is the viable way of raising capital at an early stage, especially on a state-by-state basis with your followers and the people you cater to, depending on the industry you are involved in. We have been very successful with life sciences companies and biotech company raising the initial $3 to $4 million under those provisions. Now, just to touch very quickly, Reg D under the Title III, 506C, Reg D allows you to solicit, but the burden of proof has shifted, and now issuers have to be aware as to who is an accredited investor. And therefore, liability will lie in identifying, or the ability to understand, basically like a KYC and a little bit more deeper, because you will need some tax returns here, to understand who's your investor. The good news with Reg D is you have no limitation on the amount of money you can raise. The shares are restricted, but you are limited in the amount of type of investor that you can bring in. The good news is only 3 to 4% of the actual accredited investors in the US are participating in deal, if at all. That's how crazy is that number. 3 to 4% of all accredited investors are participating in deals. But from our standpoint of view, leveraging today's social media, the internet, accredited investors are not the guys who are really looking for a deal on the internet. It's more of a militant way of doing things. So there is a site that you can look at that does a lot of Reg A offerings for real estate, developer-based. It's called Fundrise. And I apologize for my French accent, but it's with a U, Fundrise. And they have been closing multiple deals online through Regulation A as developers and soliciting in certain regional area investors, and that's how they build those products. What I suggest now is maybe we'll do a Q&A if you have any questions, and it will help me go through the continuation of this panel. So anybody, please, in the back. Well, it varies from state to state, but if I had to do an average of it, it is about $800, the cost of Blue Sky. It's really a administrative fee. Per state, correct. Now, some states are $2,000, some states are $100, but the reality of it is the people are choosing the states that they are going to solicit their offering. Actually, you can solicit everywhere. You can only accept an investor that is a legal resident of the state you have been pre-registered with. And the cost of Blue Sky, if you were to do it in every state, would be pretty high for a small company or a startup. But if you choose strategical states that are non-merit states, then it's fairly easy to go through and get it approved.
You say non-merit?
Non-merit state. There is two types of Blue Sky issues with the state. Some state will take the finding of the SEC, give you a little bit of a hassle, but it's really pay my fees, I don't care, the State Securities Commission will take it. Some states are a little bit more complex, and they want to protect their non-accredited investors, and therefore they will put a front and start commenting on your registration statement or your offering statement, that's how it's called, and therefore you will get a feedback back and forth with the state the same way you did with the SEC and therefore those are considered merit state. Imagine California is a merit state, and therefore, you know, a lot of movies were not funded in California because it's very easy for the movie industry to create a Reg A and say this is my film, and they were able to solicit everybody in the state of California who dreamed to be an actor to put $500 per share or whatever.
So once the comments begin, $800 per
Pardon me?
Once the comment period begins with the state regulator, $800 fee is going to start to climb.
No, actually the fee is a one-time fee at the state level.
Don't you need counsel to go back and forth?
Yes, no, you're right, but usually counsel works. Most counsel that do that, there are not that many, but they usually work with you on a flat fee basis. So the legal cost is probably the most expensive cost if you didn't do an audit. We recommend companies that can afford it to do a full-blown audit because it gives some credibility, and also if you're a banker or a underwriter for the deal, usually they are self-underwritten, but you want to have an audit because you are going to put yourself out there. You did some due diligence on your client, and we think bankers should quarterback those deals. Most of those deals have done them without a broker or a banker in the middle, and therefore we feel that companies need a hand-holding with a professional, even though the solicitation allows you to raise money from anybody. So the legal cost should vary between, I would say, $20,000 to $50,000 depending on the law firm. The audit cost, well, depend on the auditors, obviously. And if you don't do an audit, you need to have a reviewed financials, and those costs are substantially lower on the accounting side.
But the basic advantage to Reg A as compared to a regular S1 filing is supposed to be cost, or time, or both.
The best advantage of Reg A is really the fact that now everybody can put money into your deal. You're not subject to SEC requirements, and you're not subject to SEC compliance from a reporting standpoint of view, so you are not subject to Sarbanes-Oxley, and at the same time, your shares, even though you're a private company and therefore you don't have to disclose anything, are free tradable. So if you plan on going public, you already will trade. If you are private, second market could be a great alternative for your issuer to leverage those ability of sell chunk of stock in private companies. There is really it's a no-brainer, because if you are going to do a Reg D and plan on raising only $1 million, why would you limit yourself to the fact that you can only bring accredited investor into the deal? If you're going to do a Reg D, and really the major part of your investors are located in 2 or 3 states, then the cost is not that of an impediment. If you believe that you have an investor in one state that you never thought of, for instance, Florida, which is a difficult state to get the blue sky approved for, but he's going to put enough money that it's incentivizing you to file there, so you file there and get his money. There is no downside to a Reg A offering, and there is many to a Reg D offering, unless you plan on raising more than $5 million.
From an issuer's perspective, I can see where you're coming from. From a broker-dealer's perspective, we have to deal with suitability. So the fact is that FINRA would come in and say that a non-accredited investor is not suitable for something like this. They can turn around and sue us and look like that. So I don't know that it's much of a benefit from a broker-dealer's perspective to bring in non-accredited clients that's going to be regulated.
Actually, we dealt with FINRA on that. We sent a letter. The question was, as a broker, from an insurer standpoint of view, I understand where I'm coming from, but from a registered rep or broker-dealer standpoint of view, there is the necessity to deal with suitability issues. And therefore, the solicitation to non-accredited investor can bounce back, and FINRA, who has authority over registered reps, would come back after the brokers and say, you allowed a non-accredited person to participate in the deal. So the answer to that is, in my view, fairly simple. I understand FINRA can do whatever they want, and we're dealing with FINRA. We have a department that deals with that, and whatever FINRA tells you, they can tomorrow come and change their mind, and it will be, and you will be right. and it's a very pertinent point. However, the law permits you and favors an underwriter or a registered rep to take over the offering and assist the company in raising capital. Because you file Blue Sky, because you get approved by the SEC, you have a carte blanche to solicit in that state and bring those capital into the company. That's your immunity card. I've been declared qualified, my offering has been declared qualified, I registered as a underwriter and BD representative of the company, it's a best effort offering, and we are allowed to raise money. Now, we suggest that you create a threshold that is a mid-level threshold. So for instance, you don't want 10,000 investors at $100 a piece, you want 500 investors at $10,000 a piece. And that also will allow you to go through that. It doesn't mean we don't use a questionnaire, like an accredited questionnaire, where also we figure out the legal residency of that investor, but we can also create additional criteria. You can be stricter than the rule, but still below the threshold of Reg D. And that's where it comes into play, I think. Plus the ability to market the product, the equity in the company, through any medium. You could be on QVC tomorrow and say for every bag you buy, you get 10 shares. I mean, that could be. And I think the world is going toward that direction of disintermediation. And therefore, it's important and crucial for the survival, in my view, of the registered reps and the BDs to find their legitimate place in that world that goes through disintermediation, where people go directly to the companies and put basically B2C money. And that's what I think BDs have to reinvent themselves and participate. But, yes?
So when you complete the Reg A file and have it filed with the offering, you'll then be qualified to list and trade on OTCQB?
Once you file a offering statement with the SEC and the offering is deemed qualified, which I will use the word effective, so most of you know that word, you can decide to do a self-registration, a Form 10 or an S1, and be listed on the OTC markets. However, if you qualify, you can also apply for a direct listing into NASDAQ, small cap, Amex, or even the New York Stock Exchange. You could do an IPO from there, having 2,000, 3,000 shareholders, 4,000 shareholders. It doesn't matter. If you have the asset requirement and the share value requirement, you could immediately be listed on the national exchange and not a quoting system. Yes, Sheldon?
Yeah, but then of course you would need audits.
Yes. You will need to comply with the exchange requirement, the SEC requirements for going public. You will need audited financials. But we recommend that you have audited financials even at the Reg A level, even though they are not required. Reviewed financial is sufficient to raise capital and solicit anybody. Any other questions, guys? Yes, sir.
It sounded like this is lifting the alternative 144A requirements that you can't trade, is that correct? When you're on
Well, it's an exemption that allows for the shares to be freely tradable. And therefore, you are not subject to 144 if your Form 1A has been filed. Correct.
Then secondly, on the deal coming in sort of in the interim, is that because they would offer a protection of the slip of the non-accredited to validate an offering, otherwise because it would only fall into a 35, 65 slice under the old regulation of this new.
I'm not 100% understanding the question, but correct me if I'm... What? That's good. All I can tell you is, my view is that a broker-dealer should be still an intermediary, even in the Reg A offering when you do not need one, because I think that the companies that are interested in solicitation of capital, when the stock is freely tradable and when they don't need an audit financial, would probably need somebody to quarterback that deal to make sure that the representations are genuine and that the transaction, the subscription, and the entire offering process is conducted through a professional. I'm sure I will get down and remember that I forgot to say something, but, you know. So again, I'm the founding partner of JS Barkatz. We have 22 attorneys in New York City. We have an office in Israel, in Moscow. We are in Connecticut and New Jersey. We represent 16 public companies and hundreds of private companies. We do a lot of Israeli deals, licensing in the US, and we focus on Regulation A offerings, which we believe is the only vehicle that allows for general crowdfunding with a big C, not the Title III crowdfunding. If you have any question, you can meet me. I have also 2 booklets on your tables that I wrote. One, the use of finders in the securities industry that I recommend. It will explain to you why you cannot pay commission to somebody who's not a registered rep. And for those who plan on going public, a small handbook explaining to you your obligations as a small public company. Thank you for your time, guys.